You'd assume that the company synonymous with streaming, the one that trained an entire generation to binge watch instead of turn on cable, must have been printing money for most of its existence. Hundreds of millions of subscribers, shows everyone talks about, a brand so dominant it became a verb. That's the story people assume happened. What actually happened is that for most of the years Netflix spent building that empire, the company was barely profitable, sometimes not profitable at all, and was quietly taking on tens of billions of dollars in debt to keep the whole thing running. Understanding why reveals something most viewers never think about: a business can look wildly successful while its actual financial engine is far more fragile than the subscriber count suggests. Start with the basic shape of the problem. Netflix makes content, often years before it earns back a cent from it, and then sells access to that content through a monthly subscription that trickles in slowly, a few dollars at a time, from hundreds of millions of individual people. That mismatch is the entire story. A single prestige series can cost tens of millions of dollars per season before a single subscriber has watched an episode. The company has to spend the money now and hope the audience shows up later. Multiply that bet across dozens of shows and films released every year, and you get a business that is constantly spending far more cash than it's currently collecting. So how did Netflix cover that gap for so long? The honest answer is debt. Beginning in the mid-2010s, as Netflix shifted from licensing other studios' shows to producing its own, it started issuing billions of dollars in corporate bonds to fund that content pipeline. At its peak, Netflix was carrying somewhere in the range of $10 to $16 billion in long-term debt. That number matters because it means the company wasn't funding its growth primarily from the subscription revenue coming in the door. It was funding growth by borrowing against the bet that future subscribers would eventually justify the spending. For years, that bet paid off in exactly one currency: subscriber growth, not profit. And this is where the first real correction to the popular assumption shows up. For most of Netflix's public life as a streaming company, Wall Street didn't primarily reward Netflix for making money. It rewarded Netflix for adding subscribers. Quarterly earnings calls were built around one number above all others: how many million new signups did the company post? Profit margins were thin, sometimes barely positive once content amortization was factored in, but the stock kept climbing anyway, because investors were pricing in a future where all that global scale would eventually convert into real earnings. The apparent product being sold to the public was entertainment. The actual product being sold to investors was growth itself. That distinction explains a decision that otherwise looks strange. Netflix kept increasing content spending even as its own free cash flow stayed negative for years. Spending more on shows wasn't just a creative choice. It was the fuel for the subscriber number that Wall Street was actually pricing. A slowdown in new content could mean a slowdown in new subscribers, and a slowdown in subscribers threatened the entire premise the stock was built on. So the company kept spending, kept borrowing, and kept growing, because in this system, standing still was more dangerous than running up debt. That system worked as long as one condition held: competitors weren't also fighting for the same subscribers. That condition broke around 2019 and 2020, when nearly every major media company launched its own streaming service. Disney, Warner Brothers, NBC Universal, and others all decided that letting Netflix license their old shows was a mistake, and pulled that content back to build their own platforms. Suddenly Netflix wasn't just competing to grow. It was competing to not lose ground, against rivals with deep pockets and decades-old franchises. The content spending arms race that followed pushed the entire industry's costs even higher, and Netflix, the company that had built its entire growth story on being early and dominant, now had to spend even more just to defend the position it had already won. Here's where the chain reaction that had been building for years finally became visible to everyone. Cheap borrowing had funded years of aggressive content spending. Competitors had copied the streaming model and forced costs even higher. Then, starting in 2022, interest rates rose sharply, making that same debt-funded strategy far more expensive to sustain. At almost the exact same moment, Netflix reported something it had never reported before in the public streaming era: a quarter where it actually lost subscribers instead of gaining them. The stock lost roughly 2/3 of its value within months. The market, which had spent nearly a decade rewarding growth over profit, suddenly reversed that entire logic overnight and started demanding profitability instead. That moment is the clearest case study in this entire story, because of how directly Netflix was forced to respond. The company had spent years resisting two things its own investors used to overlook: advertising and password sharing crackdowns, both of which risked annoying subscribers in the short term. After the 2022 collapse, Netflix did both anyway. It launched a lower-priced, ad-supported subscription tier, turning viewers themselves into a second revenue stream beyond the monthly fee. And it began actively charging households for sharing passwords outside their own home, converting millions of free riders into paying accounts. Neither move was popular with users. Both moves worked. Within roughly a year, Netflix had returned to strong subscriber growth, meaningfully higher profit margins, and a stock price that eventually surpassed its pre-collapse highs. But notice what actually changed. Netflix didn't win by making better shows, or by growing faster than before. It won by finally running the business like a business that needed to make money on its own terms, rather than one that could keep borrowing against a promise of future growth. The advertising tier meant Netflix no longer needed every subscriber to personally justify the full monthly price. The password crackdown meant the company stopped subsidizing free viewers who were never going to convert into revenue on their own. Both changes quietly answered the question that had been sitting underneath the entire company since it started producing original content. Could Netflix actually make more money from its audience than it spent creating content for them, without relying on debt and rising stock prices to cover the difference? Compare the two paths this story could have taken. In the optimistic version, Netflix's early spending bet correctly, subscriber growth eventually outpaced content costs on its own, and profitability arrived naturally as the company matured. In the realistic version, that natural transition never fully happened, and it took a stock collapse, a rate environment that made debt painful, and two unpopular business decisions to force the company into genuine profitability instead of growth-funded momentum. The failure scenario, the one investors briefly feared in 2022, was a company that had scaled an audience larger than any television network in history and still couldn't turn that audience into sustainable profit before its access to cheap capital ran out. Underneath the prestige dramas and the record-breaking subscriber counts, Netflix was never really in the business of selling shows. It was in the business of selling a growth story to investors, funded by debt, and it only became a genuinely profitable company once that story stopped being enough on its own. The real lesson isn't about streaming, or content, or even Netflix specifically. It's that a company can win an entire industry and still not have a working business model. And the moment the market stops paying for the promise of future growth is the moment every business, no matter how dominant, has to prove it can actually make money the old-fashioned way, by earning more than it spends.